was that you kind of remove the 20% of all the illiquid names or stocks that you have in the portfolio, and then run the stress test with 30% participation. So it could be that 20% of the portfolio which is highly illiquid does not come into calculations at all, and therefore the numbers that we saw were not that alarming as that they would have otherwise been. So this 20%, say you are an investor in a small cap fund, and 20% of that portion of that portfolio is, say, illiquid. And when, see, if the fund house faces a redemption pressure, and that's to the tune of, say, 20-30%, and they sell all the large cap cash, utilize the cash, and sell whatever is liquid in the small cap space to meet that 20-30% of redemption, then that 20% of portfolio which was illiquid becomes a larger portion of the portfolio, and all the remaining investors will have to have that higher portion of illiquidity, which will then come in the stress test subsequently. So are you, as an investor, ready to have been a fund that could utilize or not showcase that 20% of illiquidity, which then could become a problem if you are a remaining investor in the fund? This kind of takes into consideration that everyone near the door will run away as the music stops. But that is a big problem in the making, because you as an investor can get stuck with a large portion of the portfolio that is illiquid, and therefore you need to consider the entire portfolio liquidity and not remove that 20% illiquidity. So in some sense, the stress test give you some picture, but also hides some portion which you may not be comfortable with if those numbers become very, very apparent. So in some sense, it's a great move by the regulator to start something like a stress test, but I think it should not exclude any portion of the portfolio, because that is where the problems could lay, and therefore you may be unaware of the problem. So I think it should be 25, 50, and also the 100% liquidity that the fund house should showcase. And even in that case, Quantum's liquidity profile would not change. Even at 25%, at 50%, and even at the 100% mark, our portfolio liquidity is always is going to be one day, even now. And even at a larger size, it will not dramatically change, because we have put in a liquidity threshold into our metrics before a stock can come into the fund portfolio, and therefore we will ensure that the portfolio remains liquid at all times. So takeaway for investors, that the notion that a large fund with large AUM can face liquidity issues, or if you're a remaining investor in the fund, after they face some sort of redemption pressure, that could blow in the face in terms of liquidity if there is that scenario panning out. So you need to be aware that a fund or a mandate has a capacity, and any AUM beyond that capacity becomes a risk, and also could lead to problems like style drift and changed portfolio characteristics. We'll come to these things as we go into subsequent slide in more detail.